What if I told you that a $10,000 investment, paired with a simple monthly habit, could turn into over $1.6 million and pay you thousands every single month without ever picking a stock? That's not theory. That's what happens when you choose the right dividend strategy. Today, we're comparing three real strategies: famous dividend stocks, the SCHD Snowball, and a balanced ETF portfolio that could outperform both. By the end of this video, you'll know exactly how to build your own passive income machine and which strategy makes you rich faster. Here's everything I'll cover in this video: why most investors get dividend investing completely wrong and how you can avoid their costly mistakes, the brutal truth about individual dividend stocks like PEP, KO, and PG that nobody talks about, how a SCHD-focused strategy could potentially outperform individual picks, my favorite balanced approach that combines growth and income for maximum returns, and in the end, I'll show you exactly how a $10,000 investment could grow to over $1 million using the right dividend strategy. Most people think consistent investing guarantees retirement, but after 30 years, many still fall short. Not because they didn't save, but because they picked the wrong strategy. Too often, investors chase flashy yields or familiar names like Pepsi or Coca-Cola, without asking, is this actually building wealth or just keeping me busy? Today, we're breaking down what really works and exposing why the strategy that feels safe might be costing you the most. You'll see three core dividend strategies in action: Dividend Aristocrats, KO, PEP, PG, popular names, long histories. SCHD Snowball, a high-yield ETF built for compounding. Balanced approach, pairing VOO's growth with SCHD's income. We'll run real numbers, compare long-term performance, and find out which one gets you to financial freedom fastest. How we'll calculate everything. For each strategy, we'll simulate a $10,000 starting investment, plus $500 monthly contributions, with dividends reinvested and performance based on actual CAGR and yield data over the last 5 to 30 years. We'll show you total portfolio value, monthly income, and even how each one held up during major market crashes over 10 and 30 years. And by the end, you'll know exactly which approach would have paid you the most and why. Let me show you why stock picking fails 9 times out of 10, even with the big names. You might think owning Pepsi or AT&T would be a safe bet, but one of them lost money while the other paid a yield too weak to matter. Now compare that to an ETF like SCHD. No picking, no guessing, and it outperformed both. This is where investors mess up. They confuse familiar brands with financial performance. Stick with me. The gap only gets bigger as we go. Let's start by examining individual dividend stocks. PepsiCo, PEP. Despite its impressive track record of 53 consecutive years of dividend increases, its recent performance has been concerning. According to the latest data, PEP has seen a one-year decline of negative 26.41%, and even its 5-year performance sits at negative 1.98%. Coca-Cola, KO, has shown stronger recent performance with a one-year return of 12.28% and an impressive 5-year return of 56.43%. However, its dividend growth rate of 4.75% over the past decade lags behind PepsiCo's 7.73%. Procter & Gamble, PG, falls somewhere in between with a negative 4.48% one-year return, but a solid 38.88% 5-year performance. Now, let's consider our investor Harry. If Harry invested $10,000 equally across these three dividend stocks 5 years ago, his portfolio would have grown to approximately $13,111, representing a 5.6% annual return with dividends reinvested. Not terrible, but not spectacular either. But what if Harry had instead invested that $10,000 in SCHD? SCHD has delivered a 5-year performance of 53.55% and currently offers a dividend yield of 4.04%. More impressively, SCHD has shown a 10-year distribution CAGR of 11.33%, significantly outpacing our individual dividend stocks. With its 0.06% expense ratio, it's also incredibly cost-efficient. Harry's $10,000 invested in SCHD 5 years ago would have grown to approximately $15,355, representing a compound annual growth rate of 8.97% with dividends reinvested. That's a substantial improvement over the individual stock approach. But wait, there's more. What about VOO, which tracks the S&P 500? With its 5-year return of 93.87% and 10-year KIGR of 12.28%, VOO has actually outperformed both approaches, despite its lower dividend yield of 1.34%. But numbers alone don't tell the full story. Let's see what this actually looks like for a real investor. This first strategy looks bulletproof. 5 dividend stocks, big names, consistent payouts. On the surface, it's the dream. But watch closely, because what happens next is what trips up most investors. Even with regular reinvestment, this portfolio ends up delivering the lowest income of any strategy we tested. So what went wrong? That's exactly what we're about to uncover. Now that we've examined the raw performance data, let's break down 3 specific strategies that Harry could implement. Strategy number 1, the Dividend Aristocrat approach. This strategy involves investing exclusively in proven dividend aristocrats like KO, PEP, and PG. The appeal here is investing in companies with decades of dividend growth and strong brand recognition. Pros: direct ownership in blue-chip companies. 50-plus years of dividend increase history. Current yields between 2.68% PG to 4.16% PEP. Control over exact portfolio composition. Cons: limited diversification, all in consumer staples sector. Individual stock risk. Potentially lower total returns than ETF approaches. Requires more active management. But if you think this strategy sounds good, just wait until you see the next one. Strategy number 2, the SCHD Snowball. This approach centers on building a core position in SCHD to create a powerful dividend snowball. With its 4.04% current dividend yield and impressive 11.33% 10-year distribution growth rate, SCHD offers a compelling combination of current income and growth. Pros: instant diversification across approximately 100 quality dividend stocks. Strong historical dividend growth, 11.33% 10-year CAGR. Low expense ratio of 0.06%. Better downside protection during market crashes. Only negative 21.55% during COVID crash versus S&P 500's negative 33.9%. Cons: less control over individual holdings. Sector concentration in energy, 21.08%, and consumer staples, 19.06%. May underperform during tech-led bull markets. Now, if you're still with me, I'm about to reveal my favorite approach that combines the best elements of both worlds. Strategy number 3, the Balanced Growth and Income Portfolio. This strategy combines the growth potential of VOO with the higher income of select dividend stocks, or SCHD. For example, Harry could invest 60% of his portfolio in VOO for broad market exposure and growth, while allocating 40% to SCHD for enhanced income and defensive characteristics. Pros: better sector diversification. VOO's 31% tech allocation balances SCHD's value tilt. Higher growth potential than pure dividend approach. Still provides meaningful income, combined yield of approximately 2.42% at 60-40 split. Historically strong performance in both bull and bear markets. Cons: lower current income than pure dividend strategies. Slightly higher volatility than an all SCHD portfolio. Here's where things get interesting. We took the same $10,000 starting investment, added $500 a month, and let the numbers speak. Over 30 years, one strategy left us with just $280,000 in total value. Another, over $1.3 million, with nearly $4,000 a month in income. And here's the kicker. The highest value portfolio wasn't the one with the most income. If that doesn't make you rethink your entire dividend plan, it should. Let's compare these 3 strategies side by side to see how they would have performed for Harry. For a $10,000 initial investment with all dividends reinvested, after 10 years of investing, Harry starts to see the real differences between the 3 strategies. With the Dividend Aristocrats, KO, PEPA, PG, his portfolio grows to about $19,600. That's a 6.93% compound annual growth rate, CAGR. Not bad, but nothing exciting. Switching to SCHD, the portfolio climbs to $27,100, a 10.47% CAGR. It's a clear jump in performance, and the dividend payouts have also been growing faster. But the real standout? The balanced strategy, 60% VOO and 40% SCHD, grows to over $30,200 with an 11.7% CAGR. Harry gets both strong capital appreciation and reliable income stream. Now, let's look at where things land after 30 years of compounding, with no monthly contributions yet. The Dividend Aristocrat route builds to $75,000, paying about $3,000 per year in dividends. SCHD hits around $199,000, producing $8,000 annually. The VOO SCHD combo grows to $292,000, yielding about $7,100 per year. But Harry wants to go bigger, so he adds $500 a month alongside his original $10,000. Now things really take off. The individual stock strategy grows to $675,000, delivering $27,000 annually, or about $2,250 a month. The SCHD strategy climbs to $1.25 million, paying out $50,000 per year, or $4,166 a month. And the balanced portfolio becomes a powerhouse, reaching $1.67 million in value, with $40,500 in yearly dividends. That's $3,375 a month, combining strong growth with steady income. As you can see, both the SCHD Snowball and the balanced approach significantly outperform the individual dividend stocks strategy in terms of total returns and income generation over the long term. But what happens when the market crashes? This is the part most backtests ignore. We ran all three strategies through real crashes: 2008, COVID, and 2022. And one of them crumbled. Another kept paying, but barely grew. The third? It not only held steady, it actually accelerated. So if you think all ETFs are the same, this next chart will blow that myth wide open. So, who wins the ETF Snowball versus Dividend Stock Showdown? For total return, it's the balanced portfolio. For monthly income, SCHD dominates. Either way, picking individual stocks underperformed both.